As employment and inflation stabilize, U.S. consumers remain a driving force behind ongoing economic growth. Welcome to RealPage Economy Express. Last week, data from the Bureau of Labor Statistics revealed a significant drop in job openings for July, reaching the lowest levels in about 2 years. Additionally, the quits rate, often considered an indicator of labor market confidence, declined to 2.3%. signifying that workers are switching jobs at a notably slower rate. Another important report from the BLS showed that the U.S. economy added 187,000 jobs in August. While that figure surpassed most economists' estimates, it still was below the average monthly gain of 271,000 jobs over the preceding 12 months, suggesting a potential slowdown in employment growth. One noteworthy detail from this report is the rise in the labor force participation rate. It increased to 62.8%, the highest level in approximately 3.5 years. Consequently, the unemployment rate also saw an uptick, reaching 3.8%. On a brighter note, average hourly earnings over the past 12 months have grown by 4.3%. Since this outpaces the rate of inflation, it means that, on average, employees are earning more in real terms than they did a year ago. Now, turning to the topic of inflation, let's examine a specific report. According to the Bureau of Economic Analysis, the Personal Consumption Expenditures Index, which is the Fed's preferred inflation gauge, rose to 4.2% in July. While this is only a 0.1 percentage point increase from June, it underscores that inflation remains a significant concern for the economy. Just last month, Fed Chairman Powell stated during his keynote address at an annual retreat in Jackson Hole, Wyoming, quote, "We are prepared to raise rates further if appropriate." On the other hand, the same report highlighted that consumer spending, accounting for over 2/3 of U.S. economic activity, remained robust, growing by 0.8% in July. As we are focusing on the U.S. economy, let's delve into another crucial metric. After a 2% rise in the first quarter, the real GDP grew at an annual rate of 2.1% in the second quarter of this year. Considering that many economists are predicting an imminent recession, this level of economic growth appears quite favorable. However, when accounting for the current inflation rate and a labor market that remains relatively robust, along with the Fed's concern that inflation isn't decelerating quickly enough, the odds are evenly split that we could see another rate hike in November, and of course, such a move could present challenges for various sectors of the economy. Thank you for watching. We'll see you all again in 2 weeks.